Welcome to the Be Smart podcast, how not to be an idiot with your money. Jared, how you doing today? Did you watch the Super Bowl last night?
I watched the first half. I had just come back from Connecticut and I was like exhausted. So I went to bed at like 9 last night. I didn't stay up to watch the game.
Yeah, I was up way too late, just pounding wings. Not feeling great today. I had a Wingstop relapse.
They don't have Wingstop in South Carolina. They don't. No, I had really good ribs. Somebody brought good ribs. So I was happy about that.
You on the move again this week traveling?
Yeah, I'm going to Nashville tomorrow.
Nice. Very cool. Let's dive right into the market headlines. Surprise, surprise. We've got a tariffs headline to start it off. Trump's next round of tariffs, 25% on steel and aluminum, won't be so easily averted. President Trump said he plans to impose 25% tariffs Monday on imports of steel and aluminum, part of the structural change to the country's trade system that the president promised on the campaign trail. He also said he plans to make an announcement about reciprocal tariffs on Tuesday or Wednesday. Very simple. They charge us, we charge them, Trump said Sunday. Those will go into effect almost immediately, he said. Trump says tariffs are going to help, but there are some economists out there saying that a full-scale U.S. trade war in the world would deliver stagflationary shock to the U.S. economy. Where do you stand right now on this?
I got an alert about the tariffs last night during the Super Bowl, and I pulled up my trading app kind of to see where all the futures were overnight. And the dollar was only about 20 basis points stronger. Stocks actually went down, and then within about 15 minutes, they went up. So I guess the point is that the market impact of these tariff announcements is getting smaller and smaller. The market is getting used to it, right? So from a trading standpoint, like I think that's important. I mean, you know me, I'm a free trader. Like I think all this is a terrible idea. What's kind of interesting is that there's a steel plant in Georgetown right down the road from me that's been mothballed. And if we're going to have 25% tariffs on steel imports, they might as well like open up that steel plant again. So I think that's kind of interesting. But yeah, like, what's funny is that, I don't know if it was she that said it, but it was somebody in China that said it, in a trade war, everybody loses, and I fully believe that. And I don't even agree with the reciprocal tariffs. Like if people are putting tariffs on us, we don't have to put tariffs back on them. So anyway, this is all way above my pay grade, and I'm just trying to roll with it and make some money.
So in the stock market today, the NASDAQ leads indexes higher and metal stocks jump. How are you feeling longer term regarding stocks and gold? And we can loop in the Doge movement here too, just so we're not focusing exclusively on tariffs.
Well, did you see my newsletter this morning? Did you read that?
Yeah, I did.
I'm starting to feel better about stocks. We've had a couple of corrections in the last couple months, about 4, 5, 6%. And from a technical standpoint, they just kind of ran out of gas, and now we're back up near the highs. When I look at the chart of the S&P, it's starting to look bullish. And if you think that, I'm going to say that I was wrong. Like back around the election, I said all of this is priced in, right? Like we've fully priced in Trump's 4 years. And that seems to be incorrect to me. Like, I don't think anybody could imagine what Doge was going to do, what Trump was going to do, what would happen in the first 3 weeks. So I don't think it's priced in at all. I actually think there's going to be some more upside for stocks now. So, and gold, gold sucks. I hate gold. The more I hate it, the more it goes up. So I'm actually just kidding. I love gold, but that's what I say in the newsletter,
And it's knocking on 3,000 now. It's getting right up there.
Yeah, it's trading about 29.10. It's just about 3% away. And I even think I said on this podcast in 2024, I think you asked me about 3,000 gold. And I said, look, it's only like 11% away. We could get there in a couple of months. And here we are. So, I mean, the thing that's crazy to me is the gold miners are still so cheap. They're still so incredibly cheap and underowned. Like nobody owns them. So when that trade starts to work, oh my God, it's going to go bananas.
Let's take it to private equity. Our guy Big Ed sent this over to me. from Bloomberg. Trump takes aim at private equity's favorite tax perk again. Trump is once again saying he wants to end a tax perk used by private equity fund managers, a policy feat that politicians have tried and failed to achieve for more than a decade. Under threat, the tax code's controversial treatment of the profits of private equity, venture capital, and hedge fund managers. In the current regime, dealmakers pay a lower rate on their share of profits because these returns are taxed as capital gains instead of normal employment income. In a meeting with Republican lawmakers last Thursday, Trump said closing the carried interest loophole is a priority. Such a shift could reduce the deficit by $13 billion through 2034. How does this play into your Big Short 2.0 thesis with private equity?
$13 billion is really not a lot. I mean, you don't do it because you're saving money. You do it because you think it's unfair. And I'm gonna give you sort of a contrarian view here. I actually think the carried interest exemption is not necessarily a bad thing. Not necessarily for hedge funds, but for VCs and private equity. So basically what that means is you're a private equity person and you buy some companies and you're holding them for 7 years, 10 years, and every year they go up a little bit. Well, you don't really have a taxable event until you sell the investments like 10 years later, right? Or until they go public or they're acquired or whatever. You don't really have a taxable event, but you're marking your portfolio higher every year, and the government is taxing you on a mark-to-market basis, sort of like every year, at that favorable rate. I think it's 15%. I think carried interest is 15%. So you're not paying full capital gains at ordinary income like every single year you hold these portfolio companies, which I think is a good thing because you don't have the cash. Like I said, you don't have a liquidity event, So I'm not philosophically opposed to the carried interest exemption. But you asked me what effect it would have on private equity. I think it makes private equity a lot less attractive for sure. And I think it makes working in private equity a lot less attractive. And look, like you said, they've been trying to get rid of this for like 15 years. And now private equity, is 20 times as big as it was 15 years ago. And you have people like Steven Schwartzman, who is a multi-billionaire who supported Trump for the campaign. And Trump is going to reward him by getting rid of the carried interest exemption. Like, number one, it's going to be hard to kill. Number two, I don't necessarily disagree with it. Number three, it's not a lot of money. It's really more symbolic than anything.
I want to take the time to remind listeners of your website, shortprivateequity.com. We are updating that on a weekly, if not daily basis. So if you're watching this on YouTube, I will link it in the description below. Go check that out. Jared, you want to take it to the main topic, get back into the Reddit rabbit hole a little bit? It's been a minute.
Yeah.
Yeah, we got to get away from tariffs for a little bit. We need a break. This first one is from Kiss Your Homies. How about that? Constant Financial Anxiety is the title. I am a 25-year-old male, married with 2 dogs, and moved to NYC 4 months ago. My wife has a good tech job and makes $85,000, and I work 2 gig jobs, special needs caregiver and waiter, and make about $70K. I am a fantastic budgeter and currently have things set so we are saving approximately $2K a month. Moving to NYC put a dent in our savings and credit card debt. We currently have $14K in high yield savings and $6K in credit card debt. My wife has $12K in student loans. I've always had intense financial anxiety, and obviously moving to New York didn't help. My wife trusts me with the finances, which gives me a large sense of responsibility, and I constantly stress and lose sleep over doing things correctly. Would be helpful to hear whether you think I'm in a good place or what you would recommend doing or changing. Assuming paying off credit cards would be a good place to start, but my anxiety surrounds seeing the savings number go down.
There's a lot to talk about there. I'm kind of interested to see what the rent is. So they're making about 150 grand, the two of them together, which in New York City is passable. Like you can live on that, but you're not going to be comfortable. And it's good that he's saving $2,000 a month. I mean, if you're living in New York City on 150 grand a year and you're saving 24 grand a year, that is really, really good. And that apartment must be really, really small. You know, I don't know where the two dogs are sleeping. So, I mean, you know, it's funny because this is kind of a post about financial anxiety. And like this guy, you know, outside of a little credit card debt, this is not a scary story. Like I've heard much scarier stories than this. He's got a little credit card debt, but he's saving and he's working two jobs and his wife has a good job. Like things are good, you know, like there's no reason to have that financial stress. Now, you know, one of the things I talk about in the book and No Worries is, you know, if you want to cut down on your financial stress, then maybe make more money, you know. So his wife is, you know, she's making 85 grand a year. He's between his two jobs, he's making about 70 grand a year. You know, I'm sure there's probably something he can do to bring in more money, especially living in New York, right? Like in New York, there's a billion ways to make money.
Next one is from Soft Demand 69. Too stupid, but want to start investing. I practically have little to no savings, but I'm starting a job soon. Have been trying to read up on investing and watching videos, but can never understand where to start. Just thinking of parking a portion of my salary every month somewhere to hopefully help it grow over time. Any advice on where and how to start?
Start by reading my book.
That's what I'm thinking.
I mean, this is why I teach personal finance, right? Like, you know, like I teach a college class on kind of how to be smart with your money, which I'm sure a lot of people would pay a lot of money for, you know, and these kids, sometimes they take it seriously, but sometimes they take it for granted. But if you're not taking a class like that, then you're just kind of cobbling information from the internet and you don't really know who's legit and who's not. And there's a bunch of charlatans out there giving you bad advice. And, you know, I mean, unless you've really had a formal education in finance, like you don't really know who the chuckleheads are, you know?
Yeah, and I'll also link No Worries down in the description below because I think that is the perfect place to start. Last Reddit post from Larry Scott 9. He asks, stop 401k contribution. He's 39 years old with a wife and kid. I basically have maxed out contributing my 401k since I graduated 15 years ago. The current balance is $750,000. My living expenses are about to get significantly higher. Should I stop contributing to my 401k? And with a normal economy, will my current investment of $750,000 accumulate enough to have a comfortable retirement?
Why is he stopping contributing again? What did he say? Like something like life events or what was it?
He writes that his living expenses are about to get significantly higher.
And that's all he says?
Yeah.
I wish I had more info on that. One of the things I do in my class is I do this math problem where I take two different scenarios. Scenario one, you contribute to your 401k between 22 and 32. You max it out. And then you never contribute again. Scenario two is you start contributing at age 32 and you stop at age 62. Which scenario do you have the most money in the end? It's the first one. If you contribute for the first 10 years and then don't do anything else, you actually have more money than if you started at age 32 and went from there because of the compounding. So mathematically, to answer his question, if he wanted to stop contributing at, you know, age 39 and he has 750 grand in there, it's going to continue to compound. He'll probably retire with like 3 or 4 million bucks. Like the answer to the question is yes, but I also want to know why are your living expenses going up? Why are you stopping contributing? Because if you continue to contribute from age 39 until 62, then you're going to have like 10 million bucks, right? So like stopping is a bad idea, but you know, the question is, am I going to have enough? The answer is yes.
In the week ahead, inflation will take center stage with the CPI set for release on Wednesday morning. Updates on wholesale inflation and retail sales will also be closely tracked. Wall Street economists expect January CPI to show headline inflation of 2.9% in January, flat from the month prior. On a core basis, which strips out food and energy prices, CPI is expected to have risen 3.1% over last year in January, below the 3.2% seen in December. Do you see inflation as a wild card for 2025 in terms of how it's going to impact the interest rate environment?
I don't think so. I think inflation is going to be pretty stable. It might get up into the threes, but I think expectations are more or less anchored for now. And unless Trump does something really inflationary, and even if he does, like, it's not going to be a 25 event, it'll be a 26 event. So you asked me what I think about inflation for 2025. I think it's going to be pretty stable.
Well, you got anything else on your mind this week?
Yeah, just going to Nashville. Living out of a hotel again. So I got to tell you, I had the worst trip back from Connecticut. So my flight was out of Hartford at about 2 p.m. I get to the airport. It gets delayed 3 hours, right? Well, now I'm stuck because I'm going to miss my connection in Myrtle Beach. I call up the airline. It's American. And I said, I'm going to miss my connection in Myrtle Beach. Can I get on another flight? They said, they're all booked for the next 2 days. We can get you on a flight on Monday, 2 days later. And I'm like, well, that doesn't work. I'm like, can you fly me into Charleston? They're like, yes, we can fly you into Charleston. So I get on the plane to Charleston. The plane shits the bed. They had to get a new plane. That was another 2 or 3 hour delay. I get to Charleston around midnight. My wife picks me up because my car is in Myrtle Beach. So she drove me in the middle of the night back from Charleston. And the next day I had to go to Myrtle Beach and get my car. So I was physically exhausted from that day, and I'm just now recovered, and now I'm going to get on a plane and do it all over again.
I think that covers it for this week's episode. Everyone, like, subscribe, drop us a comment if you're watching on YouTube. Jared, thanks for your time. I'll talk to you here soon.
See ya.
Later.